Hi, I'm Peter Mallouk. Welcome to 1,000 Miles from Wall Street. I'm here with Brett Broyles, one of our most experienced wealth managers. Thanks for being with us again, Brett.
Yeah, thanks, Peter.
So we've talked a lot about some of the behavioral elements that really can negatively impact an investor's experience. And I know one of the most common ones is loss aversion, and we spend a lot of time talking to clients about that and how to cope with it. Go ahead and speak to that for us.
Well, loss aversion's interesting, and this is really where our emotions can take control in a way that could be detrimental to our financial plan. And so most of us are hardwired where the pain of losing money, by any study you and I have ever seen, the pain of losing money is twice as powerful of emotion as the gain or the euphoria, if you will, of making money. Mm-hmm. And so because of that, investors, we tend to try to want to avoid that pain. And so we will make decisions, even if it's detrimental to our financial plan, we'll avoid selling something to avoid that pain. And so that pain, So an example of that would be, selling a stock. I mean, you and I, we've had several conversations in the past with clients where, a client agrees to rebalance their portfolio, but they have this one stock and they say, well, I don't want to sell it because it's down. I want to wait for it to rebound and catch back up. And what they're basically telling us is they don't want to realize that pain. It's like admitting they made a mistake, which in reality isn't the case. It's just, investments sometimes go up and down. They're temporarily out of favor, and it makes sense to rebalance and realize that loss and move on to something that's better for the portfolio. But because of that, that loss aversion, if you will, we want to avoid that pain. We'll follow through with that and avoid that pain and have negative consequences for our portfolio.
It's the guy at the blackjack table. If they're down and they don't want to leave the table, they're going to keep playing until they break even, right? That's what everyone always says. And the problem is that stock gets back to even. It's just like the person at the blackjack table. Yeah. Now, hey, it's doing well. I'm going to stick with it when I'm up. And then you get into this whole, now I'm playing with the house's money. I'll just keep going. And so the normal outcome that I see with someone who has an individual stock that doesn't part with it early on after we have a conversation with them is they really will own it to the very end.
Yes.
And if you look at the S&P 500, the world is moving very, very fast now. And it used to be when a stock got to the S&P 500, it stayed there for 60, 70, 80 years. Today, the average tenure is 18 years. I mean, companies grow and they die and they grow and they die, and that's normal. But it's very hard to deal with that emotional component, whether the stock is down, like you're speaking to, or even if it's up. I like the test that you give your clients on whether or not they should hold that stock, so why don't you share that with us?
Yeah, so sometimes you'll have the conversation where the client will say, I want to keep this concentrated position because it's down, I'll wait for it to rebound, and when I break even, I'll get out of it. And so I'll turn that around and I'll ask them, well, what if you had all cash today and I recommended to you that you put it all in this one stock? How would you respond? Well, more often than not, they're going to say, no, that's crazy. I would never do that. But it's really no different than what they're doing now. It's the same. So, and then, I'll even show them, to your point, we're in a fast moving world now, and these stocks go, in and out of favor. And when you look at the top, the 10 largest companies in the world by decade, where we are today versus 2010 versus 2000, 1990, 1980, et cetera, very rarely are one of these companies on the list 2 decades in a row. I mean, it might be a Walmart here or there, but these companies, they peak, they plateau, and then they have competitors come in and knock them off. And what used to be Toys R Us maybe 20 years ago was Amazon today. So
yeah, that's right. Great example. Thanks for being with us, Brett.
Okay, thanks, Peter.
This commentary is provided for general information purposes only and should not be construed as investment, tax, or legal advice. Past performance of any market results is no assurance of future performance. The information contained herein has been obtained from sources deemed to be reliable but is not guaranteed.